Hey everyone, welcome back to Corporate Decoder, the place where we spill the tea on financial reports. And let me tell you, SLM Corp's latest filing has some interesting tidbits that might make you raise an eyebrow or two, especially when it comes to who is paying what for their education loans. Alright, let's dive right into the heart of it. We're looking at SLM Corp's quarterly report, focusing on their financial health and how they are managing the money. First off, their balance sheet as of late September 2025, SLM Corp, also known as Sally Mai, has total assets of about $29.6 billion. That is a huge number, and it is actually a little less than it was at the end of 2024. On the flip side, their total liabilities are around $27.2 billion. Now, let's talk about what is left for the owners, their equity. This is the amount of company value that belongs to the shareholders. As of the 30th of September 2025, total equity stands at about $2.3 billion. This is up from the previous year, which is generally a good sign, showing the company is building value for its owners. Moving over to their income statement, which tells us how much money they made or lost. For the 3 months ending the 30th of September 2025, Sally Mae reported a net income attributable to common stock of $131.9 million. That is a pretty good jump from a net loss of almost $50 million in the same period last year. And for the 9 months ending the 30th of September 2025, their net income is a strong $499.7 million, up from $482.8 million in the previous year. So financially, things are looking up year over year. A big chunk of their earnings comes from net interest income. For the third quarter of 2025, it was $373 million, a nice increase from $359 million last year. This means the money they make from loans and investments, after paying for their own borrowing costs, is growing. However, they also have to set aside money for potential loan losses called provisions for credit losses. This was $179 million in the third quarter of 2025, which is down from $271 million last year. That lower provision is good news, meaning they are less worried about borrowers defaulting this year compared to last year. Or perhaps they sold off some riskier loans. And speaking of selling loans, they had a significant gain of $136 million from selling loans in the third quarter of 2025. This is huge compared to zero gains in the same quarter last year. This tells us they actively sold off a good chunk of their loan portfolio for a profit. So when you put it all together, the net income attributable to common stock for the third quarter of 2025 was $131.9 million. This is a significant turnaround from a loss in the previous year's third quarter. And what does that mean for shareholders? Well, the diluted earnings per S-share jumped to $0.63 for the third quarter of 2025, a big change from a loss of $0.23 per S-share last year. For the 9-month period, earnings per S-share are $2.35, up from $2.18. So, shareholders are seeing better returns. Looking at the changes in their equity, we see consistent share repurchases. They bought back over 9 million shares in the first 9 months of 2025 for about $266 million. This is a common move for companies to try and boost shareholder value by reducing the number of outstanding shares. Now, a crucial area for a company that deals with loans is how much they are setting aside for potential losses. They have an allowance for loan losses, and for the 9 months ending the 30th of September 2025, it was $1.5 billion. This is up from $1.4 billion at the end of 2024. They also have an allowance for unfunded loan commitments, which is $97.9 million. This shows they are being cautious and setting aside money for loans they promised but haven't fully funded yet. Let's zoom in on their core business, private education loans. At the end of September 2025, they had over $23 billion in total private education loans. The good news is that a vast majority, 89%, have a cosigner. This is a smart move as it reduces risk. Also, a good chunk of their loans, 48%, are from borrowers with a FICO score of 750 or higher. This indicates they are lending to borrowers with strong credit. However, 7% of their loans have a FICO score below 670, which is a bit of a red flag. When it comes to delinquencies, loans that are 90 days or more past due make up less than 1% of their loans in repayment, which is quite good. They have a total allowance for credit losses of over $1.6 billion, covering about 5.93% of their total loan exposure, including unfunded commitments and accrued interest. This gives them a solid cushion. They also hold investments and derivatives, and the report details their fair value. Most of their available for sale investments, which are valued at $1.77 billion at the end of September 2025, are considered level 2 assets, meaning their value is based on observable market data. Only about $2,000 worth are level 3, meaning their value is based on more subjective Unobservable inputs. This indicates a generally stable and verifiable investment portfolio. For a bank like Sallie Mae Bank, regulatory capital is super important. They need to maintain certain ratios to be considered financially sound. As of the 30th of September 2025, their Common Equity Tier 1 capital ratio was 11.3%, which is well above the required 7% with buffers. All their capital ratios significantly exceed regulatory minimums, indicating a very healthy capital position, which is great for depositor confidence and their ability to operate. When it comes to liquidity, they have strong reserves. Total unrestricted cash and liquid investments were over $4.6 billion at the end of September 2025. This is a substantial buffer to cover their operational needs and loan originations. Looking at their average assets, the private education loans make up the bulk, around $22.2 billion. With a strong interest rate of over 10.5%, their funding costs are also managed, with an average rate on total interest-bearing liabilities at around 4.24% for the third quarter. This difference between earning assets and funding costs is what drives their net interest income. Their net interest margin, which is a key measure of profitability for banks, was 5.18% for the third quarter of 2025. This is up from 5.00% in the same quarter last year, showing they are becoming more efficient at turning their assets into profits. For the 9-month period, the margin is 5.25%. Also, a slight improvement. Sallie Mae is continuing to originate tons of new loans. In the third quarter of 2025 alone, they originated almost $3 billion in private education loans. A large portion, 37%, are deferred loans, meaning students don't have to pay them back while they are in school. This is standard for student loans. The average FICO score for new borrowers is around 756, which is quite good, indicating they are still attracting creditworthy borrowers. The report shows delinquencies as a percentage of loans in repayment increased slightly to 4% from 3.6%. While this is a slight uptick at less than 4%, it is still within a reasonable range for a loan portfolio and doesn't appear to be a major alarm bell from this filing. And finally, looking at the allowance for credit losses, it has climbed to over $1.6 billion. This is a sign of prudence, especially given the slight increase in delinquencies. They are ensuring they have enough buffer to cover potential defaults. Now, pulling back and looking at the big picture, SLM Corp, or Sallie Mae, seems to be navigating the student loan market quite well. They've successfully turned a loss in the third quarter of last year into a solid profit this year. They are actively managing their loan portfolio by selling some off and smartly originating new, generally high-quality loans. Their capital position is strong, and they have plenty of liquidity to keep the wheels turning. The slight increase in delinquencies is something to watch, but their robust allowance for credit losses and focus on borrowers with good credit, including a high rate of co-signers, suggests they are prepared. However, there is always a risk factor with student loans. Economic downturns can hit even good borrowers, and changes in government regulations around student debt could always impact the landscape. Also, while their investment portfolio is mostly based on observable market data, the few unobservable inputs they use could introduce some uncertainty, though it appears minimal based on the report. In conclusion, Sallie Mae appears to be on solid ground, showing financial strength and a clear strategy to grow and manage risk in the student loan sector. They are definitely a company to keep an eye on, showing resilience and steady growth in a critical financial segment. What is your take on these results? Do you think Sallie Mae's strategy is sound, or are there hidden risks we should be aware of? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more deep dives into corporate filings. And hey, if you want to chat more about these reports and connect with like-minded individuals, join our Discord community. The link is in the description. Thanks for watching, and I'll see you in the next episode.